we cannot predict the future with 100% accuracy. We are not sovereign, or omniscient, I should say, is the word I'm looking for there. And so, when we're thinking about, a lot of these life circumstances, if you're banking on something being guaranteed and it doesn't happen, there's a chance that could throw off your retirement, throw off, maybe providing for your kids' college or, whatever it is. And so you always have to go into anything financial with the mindset of understanding that what I think is going to happen may not happen. So that's, I think, the most broad fundamental takeaway, in my opinion, from the 2025, market price action. I think if we look at it a little bit deeper, I think Bitcoin still trades like a risk-on asset at the end of the day. And as much as, I can put up YouTube videos, or, maybe Preston Pish can talk about it, as much as we think Bitcoin is risk-off, it's just not trading that way, unfortunately. And, we can see that with, all the turmoil. Gold has caught the bid that maybe a lot of us thought that Bitcoin should have caught. And so, gold's had a really good year, and, Bitcoin hasn't so far. We'll see. Maybe it'll turn around. I don't know if we are in the bear market or not. We'll get to that maybe later. But, at the end of the day as well, just, because I know gold was another thing we wanted to talk about. With gold going up so much, I think Bitcoin, it will get there. It's just not there yet. And one data point that I looked at just to think about why aren't, institutional investors, why aren't sovereign wealth managers, why aren't they buying Bitcoin? Like, don't they see what I see? And I looked at the 4-year compound annual growth rate for Bitcoin over the last 4 years, and it's lower than gold. It's lower than the S&P 500. It's lower than the NASDAQ, with 4x the downside in volatility. And so when you look at it from that perspective, it's like, well, if they're not going to allocate in size to any asset that looks like that, we're dealing with substantially larger volatility, and we didn't get return for it, at least over the last 4 years. And so, we'll see what
Zoom
happens.
Out.
I would also add to that, because I've seen a similar statistic. When you break it down, if you could cherry pick like the top of 2021, which is exactly 4 years ago, that is very much true. But that's not how most of us, I would imagine, are approaching this asset class. We're dollar cost averaging in. So over the last 4 years, you're accumulating Bitcoin every single day. You're getting the dips, down from 70K to 16K. You're getting the dips now from 126 to 80K. So yeah, on the surface, like, that is true, but I think when you unpack the data a little bit more, you can see like that, and that's what we see as Bitcoiners, right?
Sure. Yeah, but if you're, managing a sovereign wealth fund, you don't have your paycheck coming in and you're DCAing into this. You're looking at a portfolio and deciding allocations, from that perspective. And so, yeah, you can zoom out, and he kind of, he knows that. I knew that was going to be the response. Probably that's maybe what you guys were thinking. If we look at the 5-year compound annual growth rate for Bitcoin, it is decently higher than gold. But 5 years ago, Bitcoin was a $300 billion market cap asset. And now, we've seen as high as $2.3, maybe $2.4 trillion market cap. And in my opinion, Bitcoin's just different than it was back 2020 and prior. And so, I don't know. We'll see what the future holds. I think the next maybe 3 to 6 months are going to be very informative for all of us in this room.
Yeah, I totally concur. And I think Bitcoin's different as well. Would you therefore conclude the 4-year cycle is dead? Is that over? Because, markets are not totally 100% predictable. We can't whip out a calendar and a clock and say this is the Bitcoin top. Would you agree?
No, not at all. I actually would say mindset I have around cycles is the more things change, the more things stay the same. And so has this cycle been different? Sure. We've seen performance be maybe a little bit pulled forward from what we've seen in previous cycles. And then maybe there wasn't a blow-off top. If we've seen the cycle top, maybe there wasn't a blow-off top like we've seen over the previous 3 or 4 cycles here. But there's a few interesting data points, I feel like, and one of them you guys may have seen, and this to me is, it's akin to reading tea leaves a little bit, but it is interesting, and it's just this idea that if you look from the all-time lows to the all-time highs and then back down, so about since 2015, you've had this premise where from a past all-time low to the all-time high, it was 1,064 days in between that. And then from that all-time high to the next all-time low, it was 364 days. And this pattern has repeated, again, since 2015, basically. And the crazy thing about that is if you take that pattern and you pull that forward, so from the most recent low in 2022 or whenever it was, that 1,064 days or whatever the number was, that was October 6th of this year. And would anybody like to take a guess on when the price was, we've had the all-time high thus far? It was October 6th of this year, 126,000 and some change. And so that's where I get to this idea that, again, that's, okay, is it interesting? Sure. I'm not sure how much, stock I actually put in that, but it is in this vein of, if that is true, if that truly was the top, then the cycle literally played out exactly as it has for the last 3 cycles. So are cycles dead? No, absolutely not. It's just been a little bit different through this cycle thus far. And the other data point that I look at there is, we don't see a whole lot of this on X right now or in the kind of Bitcoin spaces, but if you were around during the 2022 and even 2023 time in those, you saw a lot of predictions about, okay, yeah, we're definitely in the bear market now. Where can we go from here? And one of the common mindsets was the declining cycle top theory, which is basically just saying performance cycle over cycle has decreased historically. So we can basically do some sort of, whether it's just average of that decline across, there's a couple different ways you can calculate it, but in essence being those different ways that we calculated that declining performance across cycles, you almost always got in the ballpark of somewhere between $100,000 to $140,000 for the cycle top this year. And so again, if we have seen the cycle top, we basically fell right in the middle of what those kind of projections from that standpoint look like. And so, to tie this all together, is our cycles dead, whatever else? No, I don't think so. I also don't really think that halvings drove as much in the more recent cycles than what they have in the early cycles. I think that's more commonly accepted now too, and that maybe it's more liquidity driven, maybe it's more business cycle driven, and they just kind of happen to align, and Bitcoin being maybe more reactive to those cycles as in the price way than other assets have been. But yeah, the long and short of it is, if we've seen the cycle top, then no, things are exactly as they always have been. But that's just the big if, is are we right now in a drawdown in a broader bull trend, or are we truly turned over into a bear market at this time? Well, only time will tell on that one.
This guy is always the voice of reason because I'm the one that wants to see 500,000, a million. I'm the marketing guy, so I'm like, I want to see it go through the roof. And I will just say that back in early 2024, he told me the top was going to be 125. It was 126 if it was the top, so we'll see.
That is a pretty epic call, and contrarian opinions are what make a market. So, and I agree with what you said earlier, Mitch. I think the next 3 to 6 months, that'll put all these questions to bed. We'll get a lot of answers. So, Jacob, I would inquire you further then. Do you think we're going to see another 75% drawdown in the next 12 months to come?
Well, if financial markets have taught me anything, it's that if a whole group of people think that something is going to happen, then it probably isn't going to happen, aka what we've seen in the bull market this year thus far. And so I think the common mindset is, okay, we have seen declining volatility across time thus far, both to the top side and to the downside. And so that would lead to the conclusion that, yes, we are going to see lower volatility, aka lower drawdowns into Bitcoin's future. And I tend to accept that. I mean, and I don't take it from the perspective of, well, just because we had higher or lower upside volatility, that we'll also have lower downside volatility. I just look at it more from an asset class maturation perspective. You have a lot of new investors who are, we'll say, a lot less emotionally tied to the investment, which could, on the other hand, add to a drawdown perspective. in my opinion, what I see is these are people who are buyers and they're not traders. So they're people who are holding the asset for not forever, but definitely for a period, and they're willing to stomach, drawdowns. And further to the point, because they've already made an allocation to that, that's not something that they're going to change on a month-to-month or a year-to-year basis. Obviously, it's not everybody. There's certainly hedge funds, there's other private investors that are going to do that with large capital. But when we talk about pension funds allocating, when we talk about maybe it is some sort of governmental allocation to it, these are not people that are, okay, yeah, we're going to go ebb and flow with the market. No, we believe that this is something we need to have on our balance sheet for whatever that reason is. And so it's not that they're price agnostic to when they're purchasing it. They are sensitive to it, but maybe not quite as sensitive as what we are. And so that allows them to buy through those bear markets a little bit easier. So again, the general gist here being, I think it makes more sense that we see lower volatility to the downside as well. But again, time will tell.
Yeah, I totally agree. I think what you said there is spot on. And one data point I really like, and this actually could be broken here if Bitcoin continues to dip, but since the ETFs were created, it hasn't had a drawdown larger than 30%. So it made an all-time high in Q1 of 24, around 74K, dipped to 49, about 30%. Earlier this year during all the tariff tantrum stuff, another 30% dip. Right now we're sitting right about that 30% level. And you're right, these new buyers are far less emotional, and Bitcoin has matured, I think, to a point where we're not going to see these 75% dips. An interesting point to note here, over the last month, Bitcoin's down 30%, but the holdings of the ETFs collectively are down like 2%. So it's not the institutions freaking out and like pulling their passive bid. To me, the sell pressure is coming from, the newer participants of the last year that don't fully understand Bitcoin, as well as the class of 2020 that's sitting on like a 5X and wants to upgrade their lifestyle.
I was going to say, so you're telling me it's the Bitcoin OGs selling?
No. Well, the OGs put their Bitcoin into the treasury company wrappers. Yeah. No new liquidity into the market on the supply side.
I think maybe my hottest takeaway from what we've seen in 2025 is I really don't think that anyone, I won't say anyone, I think 99.9% of people should not be 100% allocated to Bitcoin. I love Jack Mallers to death, and he's always spouting off that he never has any fiat, but I just don't think that should be the reality for pretty much all of us.
Can you elaborate on that specifically? And is there any situation where you would say, like, go for it, be 100% long Bitcoin, put all of your net worth on a cold card and shove it under your mattress?
Well, you shouldn't be shoving your cold card under a mattress, for one. So that's the bigger problem out of this. But the second thing is, what it just gets to is there will be times. Bitcoin is a cyclical asset. We can all admit that. Right? Historically, even now, it is a cyclical asset. And so what does that mean? Cyclicality provides opportunity. And so you can either choose to ride out that wave and just say, all right, yep, I'm in this, whether that's a moral stance, an ethical stance, or just a principled stance. You're saying, I'm owning Bitcoin because I believe it's a better form of money, and I don't want to contribute to the alternative systems as much as I can. Right? So we can have those positions. Okay, if you want to do that, maybe it is 100% allocation and you just hodl through, and that's cool. Like, great. We work with clients that do that. We can still help out. We can still have conversations around that. If that is your asset allocation, is 100% Bitcoin, great. You still don't have a financial plan, to our first point. But, to this thing of why not do that, there is other opportunity. We've seen that this year. There's been many other assets that have outperformed Bitcoin this year. And so if all you did through this year is just held Bitcoin, from a pure performance perspective, you underperformed a lot of other assets. And again, maybe that doesn't matter to you, right? That's where I get to. Maybe it's a moral, ethical stance, right? Those sort of things, those emotional decisions, those principled decisions, they don't really care about performance as much, right? But if you do, and we care about growing wealth for us, for our family, for our kids, for our loved ones, then okay, let's do something less than 100%, take advantage of those other opportunities that are out there in the marketplace, in the investing marketplace, and go from there.
Yeah, a couple things that I'll just expand on is one, I think we just need to remember what the money is for. And for a lot of us, it's for our family, it's for retirement, it's for paying for our kids' college, it's for taking our wife to Italy on a trip or something, it's for giving to our church. It's for a lot of things. And so, being fully allocated to Bitcoin, I think we have to remember that there is a chance we could be wrong, and not necessarily wrong about Bitcoin in the long term, but just in your time frame. If you have a goal that's coming up in 3 years, maybe Bitcoin is not to the extent we think it's going to be in 3 years. Maybe this takes longer and it's harder than we think it's going to be to get to the ultimate, maybe Bitcoin standard world that a lot of us think could happen. So I think we got to remember that money is a tool. It's not the end at the end of the day. And, to his point with it being a moral, ethical position of being a better money, you don't want to participate in fiat. I completely understand that. And that's actually where I'll say originally was when we first started working together. But I think a lot of people are replacing, in my opinion, Jesus with Bitcoin. And they're viewing it as a savior. Where, yeah, it might make the world a little bit better, but I just don't think it's the savior that a lot of us think it is, or a lot of people view it as at the end of the day. So,
No, I totally agree. Yeah, Christ is the savior, not Bitcoin. Do you think a lot of this, when it comes to planning, simply just boils down to time preference, right? Like maybe you missed the gold run this year, but you're pretty confident Bitcoin's going to outperform over the next 2-3 years, and so maybe you're willing to say, hey, it's okay, I missed that run because I'm looking on a bit of a longer time horizon?
well, I think if you have an asset management strategy that can ebb and flow with the markets, and it's data-driven and rules-based, that you can take advantage of things in the shorter term, even if you still are a long-term investor. I totally get the maybe comeback of, well, it doesn't matter what my Bitcoin is worth in fiat terms. It's just a matter of making sure I have more Bitcoin than I did yesterday. I get that. I don't see that world happening for a very long time, to be honest. Maybe it will happen sooner, but I just think it's going to take a lot longer than probably a lot of us think. I mean, that's probably the biggest lesson I've learned just in business alone is everything takes longer and it's harder than I think it's going to be. Maybe you guys can relate to that in your life, but it's just like, I thought I'd be way further than this right now, but we're not there. So, yeah.
Yeah, and I agree. That was like my mindset when I first got into Bitcoin. I was like, it was 2020, COVID was happening. I'm like, oh, we're definitely getting like Venezuelan type hyperinflation within the next year. Like, build a bunker, get some bullets and beef, and get as much Bitcoin as you can. Like, I do think the dollar is on like a doomsday path. Eventually, it probably will be worth zero. Maybe some of us in this room will be alive to see that, maybe not, but it could certainly take longer than a lot of us would like to admit.
Yeah, and I think you can talk to a lot of people who have been in Bitcoin for a really long time. These people that have, they were earlier to Bitcoin than maybe any of us in this room, I don't know. And they thought it was going to be here by now. I know Pierre Richard, I've heard him say this explicitly, and, he's an early Bitcoiner, and he thought that, we would be on a Bitcoin standard by this point already. And I think all of us in this room can agree that we're pretty far off from it still. And so we'll see. I mean, I don't know. It's kind of back to that lesson earlier of the price action in 2025 being that nothing is guaranteed. So, yeah, we'll see.
Yeah, nothing is guaranteed. Now, I could talk to you guys for hours. This has been great, but we got a lot to get into tonight, and I want to make sure everybody has time to interact afterwards. So let's finish rather on like a happy note. I feel like we took kind of a darker twist here, but which is okay. We're Bitcoiners.
I was going to try to avoid that. Sorry.
So what's something that makes you guys bullish for 2026?
Yeah, just to be clear, I still believe in Bitcoin long term. Still own a lot of Bitcoin. Our clients still own a lot of Bitcoin. I don't want to make it sound too bad if it did. Wasn't the goal of the conversation. Bullish 2026. I mean, this is where me saying the next 3 to 6 months will be very informative. I think we could see the breaking of the 4-year cycle happen. I just don't think it's happened yet. To his point, I mean, it's playing out exactly as. I don't want to say we expected. We thought it was too obvious to be the case this time, and it's happening in real time. So we'll see. But yeah, I mean, there is a lot of potential things on the horizon from a macro perspective that could change the course of Bitcoin, and I think Bitcoin is a much more macro asset at this point, being so, at the size that it is. So we'll see. I think the Fed chair change in May of 26 is a big thing to look for. Some people want to say that Powell is playing like high school politics, or I don't know, just kind of being what's the word? Just antagonizing to Trump and the administration. I don't know. Maybe that's the case. We'll see. But I think we can all agree that when his term is up, that there will be someone that listens to what Trump wants, and that's more liquidity, lower rates, print the money. And so I think that's a big thing to look at. There's a lot of other things. Maybe he'll send out the $2,000 checks. I don't know exactly what the impact that'll have. A lot of people are saying that'll have the same impact as the COVID checks. The COVID checks were printed money, though, and if this is really coming from money they made from tariffs, then it shouldn't necessarily be new money, but it will be allocated elsewhere. So we'll see. I don't know, 50-year mortgages, the Trump accounts. There's a lot of other things on the horizon that could change. But to the other side of the coin, I mean, global liquidity has continued to go up over 2025, and there's just, again, no guarantee that liquidity is going to go into Bitcoin. So we'll see. But those are a few things that we're looking at that see, 2026 could actually be a good year for Bitcoin and break the cycle pattern that we've seen.
And I think I'd add to that just the idea that we've seen a little bit more recently, and kind of, I think the phrasing has been Bitcoin's IPO moment over the last year here. And, basically the idea that whether it is the 5-year cohort or maybe it's an older cohort, but basically that it's the kind of age-old tale in Bitcoin. We have distribution from older holders. They're wanting to upgrade lifestyle. Maybe they've changed their view around Bitcoin. They want to exit the position hold. Whatever their reasons are, it's okay. They've exited those positions. That liquidity is now hitting the market. And to me, I do get to this idea of we've seen a lot of that distribution from these folks across the year, and that's been soaked in pretty well up until recently. And so to me, I think that really is one of the more bullish things over the short term, because now you have more access for the individual to Bitcoin than we've ever had. The store of value narrative is probably as strong as it's ever been, even with normies. Like, even if they don't know anything about Bitcoin, if they do know something, that's probably one of the few things they know. And so those two ideas, again, over the short term, may have some impact, maybe not, but over the, let's say mid to longer term, I think those can play out pretty substantially. And just that when we look at the coins that are being distributed and the price that those were bought at versus what those are selling on the market at, proportionally, the new entrance into that, just the idea that, okay, if I had $100,000 a couple of years ago in the previous cycle, excluding the cycle top, or even let's just take the market bottom, is around $20,000, okay, at $100,000, I could buy 5 Bitcoin at that time. Well, disregarding the current price action, let's just use a rough number. If I have $100,000 now, I have 1 Bitcoin. And so that idea that, okay, new buyers coming in and they're, taking, I guess what I'm trying to get to is the proportionality of it. So proportionally, those old holders are selling more Bitcoin, and now the new entrants, they're having less because they don't have as much capital to buy as many. That is the bullish nature of it, because it takes many more people to actually then move the market fundamentally one way or the other. And so, okay, if we really do have all these people that are coming in and absorbing that supply, that idea, I think, could play into a pretty exciting 2026.
Yeah, I think that was well said, and it's a bit of an underappreciated point right now, because on multiple instances over the past 2 years, long-term holders have basically dumped hundreds of thousands, million plus coins onto the market. I think previously, this would have probably caused a 75% drawdown, but like you said, there's so much demand actually to absorb all that supply. That's one reason I'm incredibly bullish. And to your point, Mitch, on Jerome Powell, I think his main objective right now is to make sure he's not remembered for the money printer go burr memes. It's to make sure he's remembered for standing up against Trump's desire for rate cuts. But appreciate you guys coming up here and having this conversation, and everybody, if you could give them a big round of applause. Oh, yeah, but also, if there's any questions in the audience, we're happy to do a quick Q&A here. No questions?
And all the gold bugs are going to reply to that. We'll just buy PAX-G or XAUT and hold it on chain. And then it's like, why would I hold the on-chain gold versus Bitcoin itself? It's just, I'm saying it's interesting you bring that up, because I mean, that's truly what I see from a lot of them. So it's like, well, no, gold's the best money, and now it's even better because we can have it on chain. It's like, well, you can have it on Ethereum, which we could, talk about the security of that. But at the end of the day, there is still trust relied in that. So it's interesting to see them saying, oh yeah, here's the benefit of blockchain, but not really understanding the full extent of it, so to say.
And I think with gold too, it's actually very inspiring for future Bitcoin price performance, right? Because it's always this idea, at some point Bitcoin is going to get so big, there's not going to be any more returns. Well, gold went from like a $15 trillion asset to a $20 trillion asset, went up like 30% in a single year. And it's an order of magnitude bigger than Bitcoin. So that gives me a pretty good degree of confidence that Bitcoin still has a lot further to go over the next decade or two.
I was just going to say, there's something about gold, though, that if people aren't factoring in anymore, is the U.S. has controlled the price of gold for decades now. We control all the gold on the planet, where it goes, who holds it. We've been doing it that way for a very long time. It's why our USD has survived, because we can always leverage their gold. We hold most of Europe's gold, by the way. So we just discovered one of the largest deposits of gold on the planet in the United States. China just discovered another one. You think that's not going to be manipulated here shortly? Plus, with all the semiconductors that we're building, we eat gold. That's why gold has been going up. When we start digging again, which we haven't for 20-some years, gold price is going to plummet, because it's a held asset. You can't trade it, and you can only leverage it. Bitcoin will become the same thing. If you really want to look at long-term things, Bitcoin is the new gold in a certain type of scenario. No one country can control all of it. A single person can keep it running. Simple as that.
Right, and it brings up a good point too. It's like gold goes up 30, 40%. What do? We go and get more gold, right? We try to dig up as much as you can. You can't have the same supply side response with Bitcoin. Bitcoin goes up 40%. You want to go find more Bitcoin, plug in more miners? It doesn't work that way. It's still only 21 million.
Yeah, again, I'm sorry if we came off too bearish on Bitcoin or too much against Bitcoin. We fully agree with all of the reasons why Bitcoin is better than gold over the long term, 100%.
Yeah. Just being humble as, we missed the gold run, right? I was fully allocated to Bitcoin this year, so you got to give Peter Schiff his credit where it's due, although I do fully suspect he holds Bitcoin on the low key.
Well, I mean, people have been sending him some, so I don't know. Maybe he is still holding it. We'll see.
Yeah, he turns all his Twitter engagement and Elon checks into Bitcoin. I'm sure of that. Yeah, if there's no more questions, we'll give these guys a round of applause, and then we'll get to the next chat.
A man with your intellectual gifts doesn't waste an evening playing video games.
Damn it, woman, shut up! Bryce.
All right, the walk-up music was a great touch. Thank you for that.
I would have chose a different pump-up song, but it was nice.
I'm excited to welcome Blockware Chief Revenue Officer Danny Condon. Danny, thanks for coming up.
All right. Happy to be here. Excited to talk about mining, and I think on the back of what was, kind of the kickoff from the last one is HODL is not a strategy, right? So to kind of build on that narrative, our objective here is to talk about a different way to accumulate Bitcoin, a sophisticated way to accumulate Bitcoin. What are the benefits, the merits, the drawbacks, the risk management profile of mining Bitcoin, right? So let's rock, Mitch.
Thank you, Danny. And yeah, just to reiterate that, right? It's like buying and holding Bitcoin may not be the only strategy, and it may not always be optimal. And so at Blockware, what we've done is we've made Bitcoin mining accessible to everyone. As I'm sure everybody knows, you used to be able to mine on a laptop in your house, no problem. Now it's a super competitive landscape. You need specialized hardware, you need low-cost power, and so at Blockware, what we've done is make this accessible to everyone so you can enjoy some of the benefits of Bitcoin mining, which I'll let Danny elaborate on here.
Yeah, and maybe because this is an intimate setting here, who's mining Bitcoin today? All right, cool. That's a good level set, too, to the altitude that we hit this at. But if you think about it, like fundamentally what mining Bitcoin is you're deploying capital into buying computer servers that are constantly creating Bitcoin at a discount to the spot value of Bitcoin, right? So this is on the carry, it's a dollar cost averaging strategy. You're constantly creating Bitcoin, to discount to the spot value. We're going to unpack this a bunch, and as you can see above, like the most efficient machines right now are creating Bitcoin at a approximately $60,000 price per Bitcoin production cost, right? I like to think about it, I mean, we've got the risk-adjusted exposure, like, I think about it as emotionless dollar cost averaging, right? Yeah, I'd be psyched if Bitcoin was $126,000. And I actually think the tone of the last wonderful presentation might have been a little bit, more bullish too, right? But I admire the prudent, kind of look of that presentation. But right now, if you're making Bitcoin at $60,000 versus buying it at $90,000, it's a 50% profit margin on an operating basis for a business. Think about this as a business, even though you can do it as individuals, right? Additionally, we're going to unpack a lot of these different topics, but Bitcoin mining has significantly advantageous tax benefits associated with it. This is not a new concept. Depreciation has been a tax play for a long, long time. Bonus depreciation, 100% year one, has been a play in the past. It went away for a little while, but it's back now. So what does that mean practically? And we're going to unpack that a little bit further. It means that every dollar that you spend on computer servers that create Bitcoin on an operating basis can be depreciated 100% year one effectively deducted against your income, right? So Bitcoin mining, yeah, like you're creating Bitcoin at a significant discount to the spot price of Bitcoin. That's great. There's a nice profit margin there, so on and so forth. But this is a sophisticated strategy that's really easy to implement that enables you to be super tax efficient. And if you could, instead of really simple analogy, and then I'll get off this horse here, is would you rather take the money that you're going to go pay to the government, the federal government in this example, for taxes, get no yield out of that, not see that again, or put it and buy Bitcoin money printers? So we'll expand on that. And then the last piece there is just asset appreciation. So Bitcoin mining, you're creating Bitcoin at a discount. You've got significant tax benefits. And then you've got this treasury strategy aspect of it too. This will dovetail well into Nick's presentation next. Like this can just be a cash business where it's just an energy arbitrage business. You're selling it. It's a dividend paying business in US dollars. Or you can hold that Bitcoin, right? You might want to hold on to it because historically it's gone up.
Yeah, that was succinct, and I think you nailed the high-level points there. You're producing Bitcoin at a discount, and you get major tax benefits for doing so. Now, with Bitcoin mining, we like to think of it as kind of a pie, and there's multiple layers to this pie. And so the base layer is the land and the energy production. And that's very important, right? You need low-cost power. It's a competitive environment. And the second layer to that is the infrastructure and the operations. You've got the transformers, you've got the containers, you've got the employees managing the site 24/7. And where a lot of, I think, confusion comes when people think of Bitcoin mining, especially now in this kind of financialized Bitcoin world, they're thinking exclusively of like Bitcoin mining stocks and Bitcoin mining companies. And some of them are marketed and operate as what you would call pure play, right? But a lot of them, their balance sheet is the entire stack here. So they have land and energy, they have the infrastructure and operations, and these are all additional overhead and operating expenses that are not fully long Bitcoin, right? And so where Blockware, where we try to position our clients is at the top of that stack, right? So you can take your energy production assets in your data center, you can run Bitcoin miners, or you could run high performance computing AI servers. And so our clients, they don't want to be a data center operator. They don't want to have their balance sheet, filled with energy production assets. They want Bitcoin exposure, right? They want 100% bonus depreciation, and they want to accumulate Bitcoin at a discount. And so the model we've created, we call it a CapEx light model, where you can position yourself at the top layer of that pie exclusively. Your only capital expense is the mining hardware itself, which qualifies for the bonus depreciation, and your only operating expense is the electricity.
Yeah, I think you broke that down really well. And my takeaway there is like Bitcoin mining is simple, but it's not easy. So if you think about like, let's unpack this chart a little bit on what goes into this layer cake, because you need all of this to effectively mine Bitcoin at a profitable clip. There's really creative ways to do it. I mean, Tyler here, you can heat your house. This place is heated by Bitcoin, by Bitcoin mining rigs. I'm getting a shout out there. Let's go. Right? Like, so there's a lot of, almost like hobbyist, creative plays that you can do. But I'm trying to talk about this really from like, more of an investment perspective, a sophisticated strategy to accumulate Bitcoin, protect your wealth, grow your wealth. Ultimately, you got to do all these things. So you need land and energy. Like you got to cut real estate deals. You have to cut power purchase agreements. You got to do load studies on bringing power onto the grid, so on and so forth. That takes time. That takes a lot of money to do that. You got to go then build out data centers, right? Like not necessarily, you don't need a tier 3 Equinix data center kind of thing, but you need infrastructure, which has a significant CapEx associated with it. Then, and we kind of broke this out, you can see the AI compute and the Bitcoin compute. That's the compute layer of mining. So if you think about there's a lot of buzz around AI. Would anybody disagree with that right now? Okay. So the common denominator between Bitcoin mining and high performance computing kind of AI, generative AI, is you need land and power and you need energy. And then the optionality becomes at that compute layer, right? So this isn't meant to be a sales pitch. This is meant to talk about this, investment strategy. If you can just focus on the compute layer and you don't have to worry about the CapEx burden and the operational and time-based and expertise responsibilities of like cutting land and power deals out in the sticks and building data centers and so on and so forth, you've got this nice little window to generate passive income based on that commute and of course reap these tax efficiency benefits. So it's simple, but it's not easy. But if it were easy, it's pretty dope.
I think this chart does a really good job at encapsulating kind of the end result of positioning yourself within that specific portion of the stack. And so we gather data from Q2 public filings. When you break down all of the operating costs of some of these public miners, their actual cost to produce one Bitcoin is extraordinarily high, right? They have interest expense, they've got executive compensation salaries, they have hundreds of employees managing their facilities. They've got a bunch of additional overhead. And so you can see some of these, they're producing one Bitcoin for $200,000 per Bitcoin. And so by positioning yourself uniquely in just the compute layer of the Bitcoin mining industry, you're able to produce Bitcoin for as low as $60,000 if you have 7.5 cents per kilowatt hour and you're using the latest generation Bitcoin miner.
Yeah, not a pubco Bitcoin mining dunk fest, but yeah, the point is like, if you can do this without all the financial baggage that a publicly traded company is going to have, like you've got a lot of staff requirements, you got to have PR people, you got to have IR people, you've got to have a huge accounting staff, so on and so forth, then it's going to be a drag, right? And I think that is a little bit of a pivot, but if you follow the public markets around traditionally publicly traded Bitcoin mining companies, self-mining companies, there's a lot of pivot to artificial intelligence and HPC type, hosting. That's just because that's the highest bid for energy right now, because you're seeing specialization of these companies are like, this hamster wheel is tough because I've got all this baggage when it's really a cutthroat place where you want to shed that baggage so you can have the lowest cost possible because your revenue is going to be volatile, right? There's a lot of factors that go into that. And when Bitcoin's at $126,000, everybody's stoked, and where it's at $87,000, the world is ending, but it's going to get back to $126,000 at some point in time, right? And a lot higher. So I think just the takeaway is like, if you can do this in a way that it becomes super capital efficient, then you got like this magic solution, which is, effectively, that's what we do every day.
I think it's important to frame this too from the idea that a lot of people will say Bitcoin mining, you can't compete with the big guys, right? I think there's this unique middle ground, right? Where if you are the guy trying to run a single miner at home and you live in the middle of the city and you have really high power, like, no, you can't compete with the big guys. But additionally, the big guys come with a bunch of additional bloat and overhead, right? And so there is this perfect balance in the middle where you have access to the data center resources and the low-cost power, but you're not bringing all that additional overhead cost with you.
Spot on, yeah.
And here's a chart, yeah. Yeah, that's a really good question. So, and we can ham and egg on this one. If you think about like, if you've ever read a 10K or anything, like there's a lot of adjustments that go on,
And it's all like, you know, a lot of positioning, and it's legal positioning and so on and so forth. So they're going to position this as like, what is our cost to produce a Bitcoin? They're looking at that on effectively a gross basis of like, what is our energy cost, and what is the price of Bitcoin, and there's our price to produce Bitcoin. So we're producing Bitcoin at $34,000, you know, so on and so forth. But then if you really bring in the whole picture of that business has significant incremental costs, their employee headcount, so on and so forth. Without going into all the weeds, like there's a lot of costs for that business. Now think about you as a business on the other side of this. You may have life baggage and so on and so forth. You know, you've got overhead, you've got a mortgage, so, you know, and whatnot. But your cost to produce Bitcoin for that business is effectively just the input of your energy cost, right?
Plus, I have to pay you a service fee for you're managing this on an outsourced basis, correct?
We're blending our stuff to show I mean, there's no crystal ball, markets are, you know, changed and so on and so forth. But right now, with the most efficient machines, your all-in cost is approximately $60,000 to mine one Bitcoin.
Including our electric costs and our relationship with you guys.
Correct, because it's again, like your cost is you get a power rate, right? You get effectively economy of scale. You buy more stuff, you get a lower power rate, so on and so forth. And you know, we have OpEx as a business, but what we give to you is represented as a blended power rate. So it's like that is your cost. Now, like uptime can be variable. Maybe you're not 100% uptime. You know, maybe in peak seasons it goes down a little bit more, but you know, you have machines can have issues at times. Maybe there's a fan that breaks. So there are other costs that can come into the picture at time, you know, little paper cuts here and there. But effectively, like that's the all-in cost to mine a Bitcoin if you're doing it in a capital efficient capacity.
And I would add one thing to that is this, with the Blockware model, your all-in operating costs are not compounding with scale, right? If you're a public miner and you're operating the whole stack and you want to double your hash rate under management, well, you have to go build another data center, which means more employees and more additional overhead versus, you know, Blockware enables you to increase the scale of your fleet and you're still operating with just the electricity.
That's a really good point that I hadn't like super, you know, mindfully digested is the ability to scale without, I mean, exactly as you just put it, I'm just going to regurgitate what you said. It's like, but because you don't have incremental human beings that you need to hire for this business as you increase the amount of miners in your fleet. You're able to scale in a very capital efficient capacity. You don't have to build out incremental data centers to do this, which has costs and on and on. So you can scale it on a kind of linear cost basis.
And here's what this looks like over time, because this $60,000 number is a moment in time data point. But on this chart here, it's going back to just after the halving in Q2 of 2024. You've got the Bitcoin price in black, and then in green, orange, and blue, you've got the cost of production for various Bitcoin mining ASICs. You've got the S21 series here, the S21 Pro and S21 XP being marginally more efficient than the original model. And one thing you'll notice is there's a huge arbitrage here, right? Bitcoin, even in, you know, its darkest hour right now, is down at 90K. You're still producing it at 60K, quite a significant discount as a miner. And one of the most common pushbacks we get is rising mining difficulty, right? And I love what you said about, you know, the rising cost of production kind of setting a baseline for Bitcoin's price. And I pretty much agree with that. But with that in mind, it comes down to a matter of what you have to think about: what causes mining difficulty to rise. There's effectively two different things that have to happen. One would be Bitmain or one of these ASIC manufacturers does some R&D. They come up with superior chip technology, more hash per energy input, and that can happen. It does happen. But what we've seen over time is the marginal efficiency improvements in each new generation of ASIC are diminishing. You know, historically, a new ASIC will come out, be 100 times more efficient. All the old models are obsolete. Overnight, their resale value went to zero because it's no longer competitive, yada, yada, yada. Nowadays, it's quite the opposite, right? The S21 XP is better than the S21 Pro by a sliver. And so the net effect of this is there's now only really one way to get a significant increase in difficulty, and that's to build new data centers, which, as we discussed earlier, is time-intensive, capital-intensive. It takes a lot of time and resources. And so what happens is you get these moments like in Q4 of 2024 or Q3 of this year where the Bitcoin price runs and mining difficulty can't catch up. And so as a Bitcoin miner, your arbitrage there between your cost of production and the actual market price of Bitcoin, that's your opportunity right there. When this, this gap between, hey, Bitcoin can catch a bid and go up 50% in a month, we can't increase our data center capacity 50% in a month.
I think it's like, this is a good analogy. It's kind of like a velocity game. So if you think about the profitability equation for mining Bitcoin, you're basically long Bitcoin. You want Bitcoin price to go up. If I'm dollarizing this, which is kind of how people think about it, right? You're long Bitcoin, you're short difficulty, so you don't want more miners coming in because then everybody gets a little bit smaller piece of the pie. Those are effectively like the two factors that are competing against each other. Now, the velocity at which those two levers can move are very different. Bitcoin price can move at a very high velocity. We saw about a year ago, presidential election, like Bitcoin price on news went way up, right? We've seen over the last 2 weeks, Bitcoin has dipped 30%, high velocity. The velocity in which Bitcoin difficulty can move is inherently slower because you have real-world limitations. Real-world limitations like land, energy, power, infrastructure, capital to build out these type things. That takes time, right? Over a zoom-out period, Bitcoin, mining difficulty is going to increase so long as Bitcoin price is increasing. The shorter look at this is, can and will Bitcoin price outpace difficulty increase, on like a month-over-month basis kind of thing when you zoom out. I think one other factor I'll throw in there is if you think about the difficulty side and velocity factors, number one, you get like Moore's Law. It's harder to double something and double it again and double it again, especially what you're doubling is inherently energy consumption, right? I think that's kind of losing my second one on this, but that's a huge point where it just becomes more and more difficult. Remember the second one. The second one is we as Bitcoin miners are competing for the same relatively finite energy and infrastructure resources as this little thing that you might have heard about it called AI, right? So like AI's got a high bid right now. Public mining companies are transitioning to, AI hosting. I look at this as super bullish for slowing difficulty. It becomes harder to difficult, and there's more competition for the finite resources because there's a new dog in town, right? Where Bitcoin price, I don't know what the hell it's going to do, but I think it's going to go up if you zoom out enough.
Right, these data center operators now have an alternative way to monetize their stranded power, which is by running these AI servers. Bullish for Bitcoin mining because it means difficulty is going to go up at an even slower rate. Now you may be seeing these headlines and be like, what on earth does this have to do with Bitcoin and Bitcoin mining? And one of the things I've learned since being in Bitcoin is there is a game. There's a financial money game, and the rules of it are not taught in school. And you kind of have to go out there and figure it on your own. Like level one, as we all understand, is you can't save in dollars. They don't teach you that in school. Like the game is you have to buy hard assets. Another layer to the game is you see headlines like this that are pretty hyperbolic. Donald Trump paid no income tax in 2020. It's not because he doesn't owe a bunch of taxes, and it's not because he's maliciously breaking the law. He's just using the rules of this game to his advantage. And so I'll let Danny kind of elaborate on what these rules are.
I like the cheeky little kickoff there. To be a little cheeky on the back of this, you hear tax to rich, you make the rich pay their fair share. big billionaires don't pay any taxes. Listen, the tax code, it's like, it's law. It's written there. Like if you make over X, Y, Z, you pay, if you make over what, $600,000, you pay 39% federal income tax. If you make $600 million, you pay 39% federal income tax. Most people just look at it like that. But the game that really, really rich people play that gets kind of demonized, frankly, in like the public forum is that there are ways that you can take advantage of the tax system, which is what really, really rich people do, right? That effectively incentivizes investment and gives you tax efficiency on the back end of this. So what I personally like, and I put my money where my mouth is on this in mining Bitcoin, is I like that I'm not a billionaire and I can play the same game that the billionaires can play, and I can pay legally less taxes by investing in what is actually passive income generating assets. Right? A very simple thought of this is like, you can go make a charitable donation, and there's a lot of noble reasons why you might do that. You can write off that tax. You can write off that against your income. There's rules around that too, and limitations and so forth, but that's straightforward. But that's not generating like yield on the back end. That's not generating passive income. So personally, what's interesting to me in this is like, if I can lower my taxes by making an investment and that investment then generates passive income that is also denominated in Bitcoin, which I happen to be very bullish on. And even if I weren't, I could just sell the Bitcoin and take the passive income. You want to talk about leveling the playing field? This is a leveling the playing field play. This is like something that anybody can do. We've got some examples in here of like, here's what it looks like if you make $1 million. Guess what? If you make $50,000, you can do this. If you make $100,000, you can do this. Anybody can do this.
And this he's talking about, as I'm sure many of you already know, is 100% bonus depreciation. And when I first heard about this, I thought it sounded too good to be true, but it's legitimate, and we've helped so many people execute this strategy this year. And it's you can depreciate 100% of your Bitcoin mining hardware cost in a single tax year. And it's no coincidence that this became law under the Trump administration, right? Because this has historically been his play with real estate. But the problem is you can't, the average person can't buy billions of dollars of Manhattan real estate and depreciate it to any significant amount, right? But anybody can buy one miner, you can buy 100 miners, you can buy 1,000 miners and depreciate it to zero in year one. So very simple example here. Your business earns $1 million in profit. You're taxed at 39%. You owe $390,000 to the government. You purchase $1 million of miners, 100% write-off in year one. You lower your taxable income to zero, and consult with your CPA. This is not technical, legal, financial advice, but you could owe zero in taxes legally without breaking any laws. And in addition to that, you're getting these Bitcoin printing machines.
Yeah, I think that's a really good, cut and dry, $1 million, here's what it looks like. And in that, it's like, okay, just by making the purchase, you've offset $390,000. So you can then kind of start to look at these investments through like an adjusted lens type basis. Well, Mitch, I'll actually toss back to you. I think you're rolling on this one.
Yeah, I mean, it really is kind of as simple as it seems, right? You can purchase these and write them off 100% in year one. There are certain stipulations with this. So one of them is, in order for this to qualify, you have to show 100 material hours into your mining business. But that's pretty flexible in terms of how this actually looks. For example, if you document your time here at the space learning about Bitcoin mining, that counts as time you spent working on the business. The way I think about it is when I was 15 and I turned 16, I went to get my driver's license. I had to show, hey, I spent X amount of hours driving with my mom and dad, and getting that, just writing it down and showing the people at the DMV, yeah, I did this. More or less the same situation here. You have to document that you spent time working on your mining business.
This is not legal tax advice. We can put you in touch with an accountant. But I will give you some directional thoughts on this as I look at this as an ordinary human being like myself. There are pockets in tax bracket if you look at the tax bracket, it goes up the more money you make, right? It's pretty straightforward. But, and I don't have the numbers, sewn into my head, but there's a big drop off between like making X and paying 35% in federal income tax and making Y and paying 22%, right? And then X to Z on going up is like, 37 to 35, 37 to 39. But there's kind of sweet pockets, because we're giving an example where it's like, spend all your money on this. Like, you need money to live your life. And you make money so that you can live a good life, right? But there are like sweet spots where you could say, hey, if I'm going to make up numbers here, but there's $300,000, and if I can get my income down to $200,000, and now I'm lowering my federal income tax bracket from 35 to 22%, now I'm getting taxed at 22% on $200,000 versus getting taxed 35% on $300,000, right? So there's like a lot of ways to thread the needle, and we work with a bunch of CPAs. Like, if anybody wants to jam on this, we're happy to put you in touch with folks. But it's like, it's the best game in town. This is what rich people do, and this is a good mousetrap. And if you like Bitcoin, you're accumulating Bitcoin, and you're dodging taxes legally.
Right. It's when we think about our previous conversation, right? You got to have some kind of plan, and a good way to diversify your Bitcoin exposure by producing it at a discount while also getting the added whipped cream and cherry on top of giving Uncle Sam fewer of your time and energy. I think that's a pretty good incentive there. Yes, sir.
Have you ever heard of the theory that, a brand new virgin Bitcoin that we generate on here could be worth more than a Bitcoin that's 10 years old?
I would say it's been tried 10,000 times, right? There's an unlimited amount of altcoins that have been attempted, and none of them have.
I think I know what you're saying, and this is like, we can go out there for a sec, right? So, yes, and I'll give you, so yes, I've heard of the theory, and it's not totally unbased. It's got some theoretical merit to it. Let me give you an example, because the ones that come to my mind are like areas in the world where they are worried about censorship and money getting frozen and so on and so forth, which isn't applicable here. But like, I hear about Russia, right? Like, they want virgin Bitcoin, or Dubai is very close with, the UAE is close with Russia, and they want Bitcoin. They don't want to get entangled with Bitcoin that was previously in a Russian wallet. I mean, this isn't how wallets work, right? But if it's if it's on chain, so like, it's almost like an ordinal thing. It kind of, do you believe in fungibility or non-fungibility? Is one Satoshi more valuable than another because it's got, a JPEG on it or whatever? So it's kind of in that school of thought. Personally, I don't think that's got a ton of legs, and I think the legs that it has are usually based on generally nefarious activities where there could be plausibility for valuing that more. But like, it's synonymous to saying like getting not a great analogy, but like if you get a $100 bill fresh out of the mint, is that better than a $100 bill that wasn't fresh out of the mint? And then maybe that $100 bill gets taken away because like it's proven that was a bill that you got that the cartel had, right? I mean, like, I think it's a little bit woo-woo personally, but it's not totally unbased. Like, it's got some merit to it. And I do believe in utility, and I think ordinals are interesting. So we're going to be around. We can have a drink. We can talk all about that.
Yeah, my apologies. I did not understand the question there. I thought it was an altcoin question. But to that conversation, I think Bitcoin is fungible, but there certainly is a strategic advantage for different nations having hash power, especially when it comes to censorship, right? When we think about the Russian sanctions of 2022, them being cut off from SWIFT and the financial system, like, if you're any nation state and you game theory it out, it's like, yeah, you want to have some amount of hash power so you can ensure your transactions get into Bitcoin blocks. And so I think, he's a controversial figure in the Bitcoin world, but Jason Lowery, I don't think it's a coincidence he went to the Pentagon and then went dark, and then less than a year later we got a strategic Bitcoin reserve. So I think at a, at a certain level, certain moves are being made in this regard. We know for a fact that countries like the UAE are certainly getting into Bitcoin mining, Egypt, other places. So it's that's certainly where the puck is at right now, and where I think it's going to continue to go. And here's a picture of me at one of our lovely facilities. It's kind of a change of topic here, but we wanted to kind of round out the presentation, providing a little more context on Blockware and who we are. So this is one of our partner facilities in North Texas, rather. So this one's co-located on a wind farm, right? This wind farm, prior to Bitcoin miners coming in here, they were wasting 40% of their power. And so by putting a Bitcoin mining site there behind the meter, they're able to draw power from the grid as well as from the wind turbines, and it gives the wind farm there an actual profitable use of that power that was otherwise going to waste. And we have data centers all across the country. I'll let Danny elaborate on it a little more, but I think this graphic here does a good job kind of encapsulating
I mean, I think like we wanted to be educational, through this, and a lot of this is like, I like Bitcoin mining for a lot of reasons, but I think it's like a risk management play. So you're not YOLOing in, I'm emotionlessly dollar cost averaging into Bitcoin. I don't care that Bitcoin's worth $87,000 right now because I think it's going to be worth more, and I'm making it at $60,000, right? Fly with that. But it's simple, not easy. Like we're trying to show, like Mitch just showed that site. That took like 3 years to go from 0 to 1 with permitting and building, and cost tens and tens of millions of dollars to do. So I think it's a risk management. It's a relatively risk off like capital allocation as you look at it from like a investor perspective. And then to succeed in this is about time in the game. Like this is about not effing this up. This is about making sure that you can stay hashing for 2, 3, 4, 5, 6 years. There are S19J Pros that 3 weeks ago, were mining in the money that people bought in 2020, and they made their money back like several times over, right? So where we really focus on, because we've been doing this since 2017, which in this world is like forever, is managing and mitigating risk. So you've got, geopolitical risk. And this is like, you've got domestic geopolitical risk. You've got grid risk. You've got a bunch of different risks. So we've built this model where we operate, 10 different sites in 7 different states. 1, 2, 3, 4, 5, 6, 7. Yep, got it. And what that means is like clients are able to geographically disperse the locations of their machines. Got a couple clients in the room right now. One of them is my dad right there. And you can put them in different locations so that, some of this is PJM grid in Kentucky. Some of this is ERCOT and or behind the meter, with a co-located wind farm in Texas. Some of this is in Iowa, MISO, right? So it's like if there's an election or something changes in Iowa, you're not shit out of luck, right? Or if Texas, or if there's you get what I'm saying, right? So the point is like, this is a risk management play, and succeeding in this is a risk management exercise. And that is how we help folks succeed. And when people succeed, our business does well, right? So it's all just about managing risk, because you set it and forget it, you're going to win, is like what history has historically told us from inception to right now. I don't know what the future holds. Maybe Bitcoin goes to 0. I don't think it's going to, right? But so if you manage risk, which is the focus of our business, you got a better chance of winning.
It may be preaching to the choir to emphasize the importance of decentralization to Bitcoiners, but that's really what this is, right? You can decentralize your mining operation across multiple different states and facilities, and I think all of us here in this room definitely understand the importance of decentralization. And to kind of round things out, all of this can happen under one simple user interface. And one of the things I love about Blockware is our marketplace. So it provides real-time, don't trust, verify, transparent analytics into everything you would want to know about your mining operation. So even if you have miners scattered at 3 different facilities in 3 different states, you can have the entire performance of your fleet aggregated into one dashboard. Energy consumption, hash rate, uptime, revenue, everything you'd possibly need to know in real time, all on one platform.
Yeah, I mean, not much to add there. It's just like putting a bow around it. What we do is we sell ASICs to individual and institutional investors and provide co-location hosting services. So this is a asset-light, capital-efficient way to get access to a kind of risk-managed way to accumulate Bitcoin that also has material tax efficiencies associated with it. But you can just do this through one lens, right? Be it Kentucky, Georgia, Iowa, North Dakota, Texas. Like, you're not going to all these places, cutting deals in all these places. Like, our model is our customers get the benefit of our growth and innovation, both technologically and geographically, as we grow our footprint, which further de-risks this for everybody and creates a better product.
Yeah, and with that, we'll open the floor up to questions. We hit some as we went along, but. That is a great question. So it's a very important distinction, and this is what allows this to qualify for bonus depreciation, is you are not buying hash rate. You are buying specific miners. They have serial numbers attached to them. And on the pool, right now we have the Blockware pool. It's your standard FPPS 2% fee pool payout structure. We've considered like Oceans as kind of the main one we get pushback on. We're not generally, conceptually opposed to it, but what we've seen so far is it doesn't necessarily provide the consistently higher payout, and our clients prefer the consistent, predictable stream of revenue with an FPPS.
No. It's okay. So our clients are buying we're basically a service provider. So they're buying machines, and then you basically put your wallet address into the portal.
Yeah, I understand the semantics here. Yeah, we're not constructing our own blocks. Yeah.
Yeah. And pool is a deeper dive. Who knows what a pool is? Just real quick, so I can hit this at an altitude. Okay. This is a quick education point I'll do real quick. I look at pools in kind of two ways, and there's a bunch of merits. This is going to be quick. Our customers generally are looking for like consistency above all. So an FPP, think about a pool as like a union, right? So only one miner is actually going to solve the block, and they're going to get all of the Bitcoin associated with that reward. Now, if that were how this works, you'd have no advantage of scale or anything, so you'd just be buying a shitload of lottery tickets, right? So that's why pools exist. Think of pools as like unions. And an FPPS pool is like where our union comes together and says, well, the union says that directly proportionate to the amount of work that you perform or the hash rate you contribute, you're going to be paid a proportional allocation based on the work you perform. A PPS pool, this is not going to be a perfect analogy, and you know about pools, so don't skewer me for this. But it's kind of like the union analogy, but it says, okay, we're all together, and we're going to share. But what we kill, we're out hunting, right? So in my previous analogy, the union says, we're going to pay you even if we don't get any kills. They're basically accepting the risk, and their business model is that they've got enough scale, they're going to get more kills in the hunt than they otherwise would. With a PPS pool, it's like the union comes together and says, we're going to all eat, again, still proportionally, but only what we kill. So if we go get like 7 elk, instead of 3 elk, we all eat more. But if we only get 2 elk, we're all playing the lottery, by the way. That's the game we're playing. Then everybody gets a little bit less. There's a bunch of merits. I personally like the ethos of like Ocean, for example. But for us, for our customers, generally they prefer like consistency and planning and prioritize, as a priority. So if anybody wants to go deeper on pools, we can talk about that. But I'll say one other thing. Technically, our customers just interface with our really, really highly sophisticated, like expensive, well-built platform that we call the marketplace. So there's a bunch of APIs feeding stuff in from like Foreman, from pools. So we make it really easy so you don't need to know any of this stuff frankly. You can, it's cool, but you don't have to.
Yeah, and I would just second that. Like conceptually and, even you could say ideologically, I have nothing against Ocean Pool, but our clients want the consistency of an FPPS payout. Yes, ma'am.
So like when you're talking about your cost is much lower than your competitors, I'm just wondering like why your competitors, mine at a cost that is even more than the Bitcoin price.
It's a good question. And to be clear, the analogy we put up is like, it's more meant to be, frankly, an analogy where if you think about all the costs that go into mining Bitcoin, if you're just going to go out and do this, you got to go finance that whole stack, right? And then you need to pay people who are going to execute on that whole stack. So the business has more cost, right? Let's just say that the cost of power is the same to remove a variable. So the gross cost to mine a Bitcoin, energy in, energy out is the same. But if you have a staff that you have to pay and buildings you have to build, then you have more cost in that business, which means that your adjusted returns are going to be lower because your revenue is going to be the same, your gross profit's the same, but you have more cost. What we enable is you don't have all that cost, right? You're just, you might, now in reality, those giant public companies, they have power at it fluctuates more, but they're 3-4 cent, gross cost per kilowatt cost of power. But they've got a bunch of other costs there. So what we did is blend those in and say, look at all the costs they have. This is actual data from 10Ks and so forth. So what we're saying effectively is that if you can do this in a capital efficient way without having that cost, then you have more profit.
I guess my question is why do they even want to do that since they are losing money when they might?
Why does go look at these are we're using publicly traded companies. If you look at public markets, there's a shitload of really valuable publicly traded companies that don't make a profit or that don't that's a extreme example, but it's a different game, right? It's because you're building asset value, why do they do that? They can answer for themselves, and I know a lot of these people personally, but, they're going and building all these assets. Those assets have value. Right now, these public companies are actually pivoting their assets that have value to not mine Bitcoin anymore because it's a hamster wheel for them because they have so much cost. They're saying, we're just going to rent out our infrastructure and just be an infrastructure and energy company to AI hosting companies. So it's not that you're not going to do something if it's not profitable, but a lot of companies don't make money and the market places a value on them based on what their value can be because markets are forward looking, especially in a public sense.
Additionally, I would add to it is, I mentioned this earlier, but a lot of them, you're almost blending multiple business models when you are running all of the infrastructure for the data center and Bitcoin mining. And one company that I think has done a great job at distinguishing this is Hut 8. So they put all of their Bitcoin, all of their ASICs into a separate entity called American Bitcoin. And that's spun off from Hut 8. Now Hut 8 has a large ownership stake, but then as an investor, you can say, all right, do I want the data center and infrastructure operations, or do I want the Bitcoin, exclusively and the Bitcoin mining upside?
Specialization, that's the key. And Hut 8 is a really good example. Who knows who Hut 8 is? Sorry, as we go. Okay. So, and Hut 8, their CEO, Asher Ganoon, I think does a really good job of breaking this down. And I'm not speaking for him. This is my interpretation of their business model. Hut 8 is, go back to that other slide for a sec. Hut 8 is focused on land and infrastructure, right? They basically put all the compute, let's go to the orange one, the Bitcoin compute, into a company called American Bitcoin Mining, ABTC is their ticker, another publicly traded company. They own all of the ASICs. So actually, ABTC is super specialized. They don't have all of the cost of infrastructure and operations. So Hut 8 is now saying, we've got this buyer, this renter of last resort who's going to keep renting our space so long as we build it. That's an incentive to go build then. And so they have certainty of revenue, X in, Y out, more or less. And then American Bitcoin Mining is more of like the Bitcoin treasury mining, kind of more going to be more volatile based on less certainty but more upside.
Additionally, one more thing I would add to steelman the public miners on their behalf would be we focused on the negatives of like scaling your mining operation in terms of building new data centers. You have to hire more employees, your costs increase. But as a public company, they have access to financial tools that the layman does not. And so while their cost of production per Bitcoin could be higher now, they can tap into the markets with debt and convertibles and equity issuance and kind of allow themselves to float by while they wait for the Bitcoin price to increase.
Well, let's do like one or two more questions, and then we'll move on because we got one more to do. And then we're all going to be around so we can jam. But fire away, man.
Have you ever, Michael Saylor talks about mining Bitcoin in the capital markets, and we've owned MicroStrategy for 3 or 4 years, and our Satoshi per share has doubled in that time. So forget about the MNAV, which was probably negative when we started buying it. So when I compare, and he of course calls it his Bitcoin yield, which is his capital markets, which is adding Satoshis per share of 20 to 30% a year. And so I just try to compare a mining operation like you versus me mining Satoshis by owning MicroStrategy shares.
So, okay, there's a bunch to unpack there. Different risk profile, I think, because, and I think that this has, is my opinion, it has more certainty, less risk. How's MicroStrategy stock doing this year, right? How's folks that are mining Bitcoin at $60,000 right now doing relative to, like, you're still making it less than the cost of production. So, like, great position, best football position, Monday morning quarterback, right? So, like, sure, that's been what it was. But let's go back, like, 2-3 years. How did MicroStrategy do when Bitcoin went from $16,000 to $74,000, right? Really, 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 really well. MicroStrategy is effectively harvesting, they're basically issuing long-dated, low-interest rate debt, taking that money, and then going and buying Bitcoin. It is kind of a YOLO strategy, but it's got, like, it makes sense, right? If Bitcoin generally goes up and you can refinance debt, there's a bunch of tools you have in capital markets to do it, and I think personally they've done a great job at it. But it goes up more at a higher velocity when Bitcoin does really well, or it should logically, because you own more Bitcoin, you're accumulating more Satoshis per share, to your point. Bitcoin mining, like, yeah, your spread, if Bitcoin price is going to go way up, is going to increase, but probably not at the same velocity that you'd see on, like, a parabolic MicroStrategy run. So it's kind of like apples and oranges. And frankly, to the point of the financial planning talk, like, one's not better than the other. These are complementary strategies. I think that dollar cost averaging off of an exchange, mining Bitcoin, owning, holding cold storage Bitcoin, getting exposure to some of these leveraged treasury companies, owning some of the mining plays in public markets, that's like a good, my dad's gonna be like, you're fucking crazy. But, like, that's a good diversified Bitcoin portfolio, right? If you just go straight into MicroStrategy, you're getting slayed this year. But if you're just mining Bitcoin, you're making it $60,000, I'm making money.
Additionally, there's one more thing I would add to that, and I love Strategy, super bullish. I think they're going to be the biggest company probably by the end of my lifetime. And I love Satoshis per share. I think it's a great KPI. How often, you don't have to answer this directly, how often do you, when your Satoshis per share increases, do you, if Bitcoin cold storage is your profit taking, like, that's the objective, you want more Bitcoin, right? That's the idea behind Bitcoin per share. Do you ever sell Strategy and then, take that, buy Bitcoin, put it in cold storage? So with mining, if your objective is more Bitcoin and cold storage, you're doing that every day, right? And so I think there's a certain tipping point at which, like, I do think Strategy will be able to continuously increase Bitcoin per share for the foreseeable future. And I think, I don't even really think over the last 5 years they have outperformed Bitcoin directly. But how often and are people actually, you know, realizing their Bitcoin denominated gains, so to speak? I don't think it's very often. And as a Bitcoiner, that's my ultimate goal, right? I want to pay less in taxes and I want more Bitcoin and cold storage. And so mining, to Danny's point, it's another way to get that Bitcoin exposure, while also, if your objective, like North Star, is Bitcoin and cold storage, you're achieving that every day when you get mining payouts.
Yeah, but MicroStrategy is not saving you on taxes, and it's not getting you more Bitcoin.
But there's no capital investment, and it's all passive. I don't pay any electric bill. I don't pay.
You got to spend the money to buy the stock.
I don't have to buy a server.
But okay, I'm with you. Let's take this to the parking lot afterward, like, you know, the drink section, just because. Yeah. It's a great question. We're gonna have some great conversations over some cold beverages.
I can kind of wrap that up really quickly. They are two different risk profiles or two different ways and methodologies, right? What you really have to look at is return on investment or return on assets, right? That percentage return is the way you compare those two. So you look back, time horizon history, then you can make your assumptions in time horizon in the future, but it's ROI, ROA, and those return numbers are how you compare the differences. But they are completely different risk profiles.
Yep, I think that's well said.
Yeah, very succinct. And I believe you had a question as well, or no?
You can fire away if you want. We got one more question, and then we'll move on. Yeah.
My biggest thing was, I was just wondering, well, is the thing? Yeah. So my biggest thing was, you were talking about the 60,000, and everyone was coming back to that. And I was like, I know that my miners cost me 86 because of what they're at. I also roll like 10 to 15,000 just because I was having the issue that my miners were sitting there, you know, gaining. Everything was going up so rapidly, and I felt like I was missing out. Well, I can tell you that just even by rolling, I've really just done the same that I've done on my miners. And I've spent probably, I don't know, hundreds of hours more into the research and trying to figure out when to actually do all the curvatures and everything. It's insane. So if you're big on gambling, yeah, you can roll your BTC over and over again. But if you're not putting it into the cold storage, it's not going to work. My question for you guys was, are you guys a shared service, or are you an actual, like I own the full miner, but it doesn't sound like it. It sounds like someone else owns the miner.
No, you own the full miner, right? Okay. So like is the short answer, right? Like we're selling you ASICs that you own. We're effectively a service provider of those ASICs, right? Like, which means that you're not the service provider. You're not like managing them in a data center, basically.
It's not at your house, but you own it. You have a specific serial number, and like if for whatever reason you wanted it to be sent to you, like it is your legal property.
Okay, so what is your base electric? Like your base price for electric?
Yeah, so our power, what we put on here, let me make two, just quick clarifications. So one, when we're talking about $60,000 break-even price of Bitcoin, we're talking about S21 XPs, which are effectively the most efficient air-cooled machines available right now. Yeah, so this chart's actually good. This is like the S21 series. So S21s are about $80,000 break-even price, right? And obviously, like, things have just pulled back a bunch. So this is time in the game type play. There are S19J Pros that came out 5 years ago that are making Bitcoin at 7.5 cents per kilowatt hour at probably close to $100,000 per break-even price, right? So like your price of production for Bitcoin is based on your energy and the efficiency of that machine. And there are ways to play it like in an aggressive way. Well, I'll say one more thing. The more efficient the machine, the more the machine is gonna cost, because these are dividend paying assets. If the dividend's higher, it's gonna cost more. If you wanna go buy a machine, we have a bunch of these in our 20,000+ fleet that's hashing, that is out of the money. You're making Bitcoin at a cost that is higher than the cost to acquire Bitcoin on, say, an exchange. Those machines will cost like $100, right? And think about that as like a low premium call option on Bitcoin, because if Bitcoin goes nuclear, I might make all of my money back in 1 month. But if it doesn't, I'm like, just, it's more efficient to just buy it on an exchange. Oh, I got you.
I'm trying not to use other companies as
Yeah, our rates range. Yeah.
Yeah. Okay.
They range
I got
from.
you. I got you.
They range from 7 to 7.5 cents.
a lot of us have multiple miners, multiple companies, multiple hosts. Like you guys are talking about heating a house. I heat my house with Avalons
Yeah.
because they're just enough for the wattage, not for my.
Yeah. So the very short blanket answer is like 7 to 8 cents. More so like 7 to 7.5, 7.6. Some of like hydro sites, run a little higher because the infrastructure is more expensive. But right down the fairway, and all the modeling we're using here is 7.5 cents. But like 7 to 7.5 is usually where we're at. Yeah. We're correct. There's a lot to behind the curtain on the model and the risk profile and so on and so forth. Yeah. All right, cool. We'll be in the parking lot as well. Yeah.
Well, if that's the last question, we have one more presentation. And Nick, I'm sorry, because you've been waiting so long, so patiently.
And we know you have to go to the airport, so
we went way
let's
longer
get
with
rock.
this than I expected. Yeah, so we'd like to welcome Nick from Arch Langdon to come join us. Let's get some walk-up music.
Hey, how's it going? Nice to see everyone. I'm Nick from Arch Lending. We are a Bitcoin-backed loan company, and we've been working with the Blockware team to bring a new product to market, which is Tax Shield.
Awesome. Yeah, you introed yourself perfectly. As Nick mentioned, we launched a joint product recently, Blockware x Arch Lending collab. It's called Tax Shield, and as you can tell by the title of our event, Turning Your Taxes into Bitcoin, the idea here is to protect yourself from the tax man. So, Nick, can you tell us very high level, what is Tax Shield?
Yeah, I think from our perspective, it's a really great collaboration that we've been working on. So I think throughout this discussion, we've been talking about the volatility in price, the exercise of wanting to put up that collateral to perhaps purchase Bitcoin miners from the Blockware team. And a lot of times that can be difficult if you don't have that upfront capital, right? If you want to be accumulating Bitcoin in a long-term perspective, you might not have that part of your portfolio available to dedicate towards purchasing. And so we offer those loans. We really focus in on security and service and making it available for you to have that collateral to then go purchase that Bitcoin mining rig. And I think that puts a really big cap on the entire strategy, because you're never having to give up any of your collateral to go after getting these miners.
And I'll tee it up for you here, Danny. I think we talked earlier about like the financial game, and there's levels to it. Level 1, you can't save in dollars. Level 2, you need a tax mitigation strategy. And level 3, and this is what would get you killed in the Dave Ramsey School of Finance, is that debt can actually be advantageous. Obviously, there's caveats to that, right? You don't want to go to Disney World and rack up a credit card debt, or anything like that, or $200,000 on student loans for a worthless degree or anything like that. So there's different, obviously you have to caveat that, right? But there is a strategic component to debt, and as Bitcoiners, we understand fiat currency loses value. So over time, if you can have liabilities in the weak currency and your assets in the strong currency, you're going to make out better. And this is what the wealthy have been doing under the entire fiat system. And so, long-winded way to tee up Danny to kind of talk about how this, what makes it so advantageous to perhaps buy miners with debt rather than deploying your capital directly?
Yeah, I think so maybe one step back with Arch as a product where, like, if you think about this is a 1 + 1 = 3, but there's a 1 and there's a 1 as well. So like Blockware, our business is selling and providing service around ASICs. Their business is about Bitcoin collateralized loans, right? Now, you can go to, I'm not stealing your thunder here, I'm teeing you up. So like,
It's a team right so far.
if let's look at this 1, for example, irrespective of this 1. There could be a number of different reasons why you might want to take out a Bitcoin-backed loan where Bitcoin is your collateral, where you're basically extracting US dollars out of your Bitcoin and you pay an interest rate because it's a loan, right? Irrespective of mining or anything, you might want to go build, a house, or you've got family expenses or whatever it might be, right? But you don't want to sell your Bitcoin. The opportunity cost is here. Do I sell my Bitcoin, my precious Bitcoin, or do I potentially loan against that Bitcoin? This is as old as time, just concept. So we can come back to that, but I just wanted to paint that framework. So what Mitch talked about, like leveraging debt, right? So I'm going to put it in the realm of thinking about buying miners with this, but I want to really quickly paint the foundation on, like, we use Donald Trump as an example. We talk about rich people not paying taxes and making money. It's a debt game. Donald Trump, I'm going to use him as an example here, basically goes and takes out loans to go build, previous, not President Donald Trump, like, real estate mogul, goes and builds Manhattan skyscrapers. That's a revenue generating asset, and then takes collateralized loans against, which, by the way, those assets have tax benefits associated with them. Then he takes out loans against that asset to go build more assets that have tax generation aspects about it. You got interest rates all across that, right? So the formula is, can I get a higher return on the use of my capital that I can extract from the loan from my asset, right? And in Donald Trump's example that I'm flying with here is like, yeah, I can go borrow at X and I can turn that into Y, and there's a bunch of ancillary benefits to that. So if you think about it from a mining perspective, I'm going to use round numbers here. But let's say that you've got a 50, 60%, LTV on your Bitcoin. I don't want to sell my Bitcoin. I want that because I think it's going to go up over time, but I want to extract capital out of it. Now, I could go buy Bitcoin with that, and I'm just YOLOing that strategy. Like, that might work out really well. I could go buy MicroStrategy with it. That might work out really well, but it might not. Or I can go buy mining rigs with it, which, think about it as more of a but more of a fixed income type play. So if I can go borrow at 12, 13, 14%, whatever the interest rate is, and I can go generate 20, 30, 40, 50, 60% return on that capital, then I'm 2, 3, 4xing my return relative to my debt. And by the way, I still have all my Bitcoin, and that goes up in value. So that was a long speech, but I think that's kind of like the wrapper around it. You feel free to opine on that.
Yeah, no, I think that's super important. I think with Bitcoin, sometimes it can be, am I holding or am I living, right? Do I have to make that choice? And I think with Arch, what we want to do, and I'm new to the team, head of marketing, but I've been thinking about what are the taglines that make sense, and what I've come to is never sell, but never settle, right? You should be able to live your life. This is pristine collateral. It should be functioning exactly as you mentioned, and a lot of our clients are doing interesting things with it, that contribute to the quality of their life, and that could be buying a house. We have a client that's always tagging us in pictures from his new boat that he's got and he's sailing around the Caribbean. I love that. But this is something that is even better because you're contributing to the potential for you to accumulate even more. And I think that's why this is a really powerful product.
Yeah, leverage your Bitcoin to create more Bitcoin and don't sell your Bitcoin, right? Like that's kind of the simple philosophy. And again, like back to this is like the game that the big boys play kind of thing. It is the same thing. It's just a different mousetrap. And frankly, it has better economics, which is why we're seeing a ton of traditional real estate investors that used to buy multifamily real estate, complexes and have tenants and look at a 15% cap rate and, depreciate the asset over 29 years is like, wait, you're telling me I can depreciate it all up front and generate a higher return and it's denominated in Bitcoin? Again, there's no crystal ball, but like it's a reasonable bet and it's risk mitigated too. Or I can sell all my Bitcoin and go into this like that. I can use my Bitcoin to buy rigs. Not necessarily a bad strategy. You get the same benefits, but then you don't have that Bitcoin.
Yeah, and I think one of the other things that makes this partnership really interesting for us is our peak value is security, but right below that is service. And so we put a lot of time and effort into developing a product that's really intuitive, that we always have a team that's available to our clients and can be there for them for any question, and that's at any sort of loan value. And so working with Blockware and the amount of effort that they've put into their marketplace and making it quite obvious to their customers, what's going on at any moment, the amount of attention and care they put into client services as well, has made it feel like, okay, cool, we can trust them and we can work together to service clients as a group.
Yeah, and I'll just tee up on that is like, or reciprocate that is, yield and lending and stuff got a shit reputation last cycle because a lot of stuff went sideways, right? So like I am a user of this product. I take loans against my Bitcoin to some degree. I like to over collateralize them because I want to really manage risk, but I'd like to, get some capital out of that to buy rigs. I like the return profile and I want to save on taxes, right? I'm doing this thing soup to nuts across that. But when I first did this, I'm like, can I trust this party? Because as Bitcoiners, we're inherently, verify first, verify, don't trust, right? And I think like we got, a lot of people got burned last cycle because there was a lot of trust that turned out wasn't so trustworthy. So it's like, I'll let you, of course, speak to that, but that's one thing that I mean, there are a number of different ways to get a loan, and there are other providers that provide Bitcoin-backed loans, if we're calling a spade, just like there's other providers that can provide capital-efficient Bitcoin mining, but it's about what's the risk profile of that, and that's why we're partnering with these guys.
Yeah, and I think, like I said before, security is our top concern, and so we never rehypothecate, right? That's structurally just part of our business. We have insurance on all collateral that's kept with us. There is backup servicers that we work with, and also it's bankruptcy remote, right? And so our company and Anchorage Digital that we work with could go under, and your BTC is safe. And so I think our company was started in 2022 in the middle of a lot of people getting some of these scars, and I think that's part of our internal mantra now is that we really, really dedicate ourselves to security and thinking about how to bring that to the clients in a way that makes sense.
That's really fitting that you spawned from the ashes in 2022. I did not know about that.
The Phoenix Labs again, yeah.
We were pre-ashes, and then we lived in the ashes, and we spawned from the ashes too. But yeah.
Oh, and just on top of that, I guess because we have that baked into our DNA, during times where there's difficulty, you might expect this to be a cyclical environment, or that maybe our customers are a little bit more angsty or troubled when the price is dropping. But what we found is actually during these moments, our Trustpilot goes up, right? We currently have a 5-star rating on Trustpilot from all of our clients, and I was a little bit concerned. I was like, oh, we're going through a rocky period. People might be concerned. No, they actually appreciate the amount of client services and the way that they're able to get our CEO on the line or our CTO or our client services team within minutes when they have a question, that we're reaching out to them proactively, that it's just a part of our business that we want to work with them for the long haul, not 1 year, 2 years, but a lifetime. And the products that we develop and the relationships that we develop are built around that, and I think are reflected in our reviews.
Yeah, that was really well said. One thing I appreciate about Arch too is some of the other Bitcoin lending platforms. I won't name names. You're restricted to 12-month terms, and as we've seen this year, anything could happen, right? Let's say, January 2025, you take out a Bitcoin-backed loan to buy some more Bitcoin. You're like, 12% is my hurdle rate or whatever. Bitcoin will go up more than 12%. Doesn't happen. You make out worse. But with Arch, you can actually borrow on longer terms. You can borrow up to 2 years. So I think that gives you a little more cushion in terms of, Bitcoin's actually never had 2 consecutive red years.
Yeah.
So when we think about what's the strategic benefit of debt, taking out longer terms is advantageous. And I appreciate that Arch enables that when some of the other Bitcoin lending platforms don't.
Yeah, for sure. And we also make it very easy for our clients to roll over. I think it's like a one-click button. It's very intuitive. We also have a product that's called Perpetual Income, which is made for retirees that hold a lot of Bitcoin. And so you can set an amount that you want to receive every year, and then you can pretty much set it and forget it, right? And so all of that is rolled in, any new origination fees after maybe 2 years or so, and you can sort of keep that at a pretty low LTV and let it run. And so to echo what you said, I think these types of instruments actually help you be more committed because you're not thinking of, my life needs these demands, my life needs this capital. You can actually think a little bit more long term if you know that you can always access USDC while keeping your BTC for the long term.
So you get to keep your Bitcoin, you get to access some of the liquidity,
Amazing.
You get a major tax write-off, and you get an income-producing asset to cover the interest on that loan.
And we launched this product. Blockware's got a pretty big marketing machine. We're pretty creative with promos. This has been honestly one of the biggest bangs I've seen out of the gate because I feel like it kind of just clicks a little bit where it's, I've got this Bitcoin. I don't want to sell it. That's the classic conundrum, and it's a way to tap into it. And I'll just say, this is a thoughtful partnership that we've launched where both parties have put, special packaging and kind of discounts around plays that go through the whole nucleus. Because again, you could just talk to Nick and his team and you can go get this loan. You don't have to use it to buy ASICs. You can talk to us and you could just buy ASICs. And you'll be great, right? But there's a way that, we put packaging around this that makes it extra, frankly, enticing to, kind of leverage both products because it is a 1 + 1 = 3 kind of, equation.
Yeah, and I think we're also continuing to innovate and listen to our clients and potential clients. And so, for example, there were a lot of very specific tax questions that came along with this product. And so we reached out to Moon Tax and Securus Advisors, OpenPath Finance. And so now we have 3 CPAs very deeply integrated into an understanding of the product that have helped us with our FAQ and are always available to any potential clients who have questions. And so I think that's the kind of thing that is really indicative of how seriously we take this product and providing the proper level of service. And we're all ears to hear how we can improve it further.
With that, I think we'll open up to the floor to any questions. Again, we'll be around. There's drinks, food, so no need to feel like we got to get all the questions here, but we will take as many as we can.
So my question for you.
Yes, please. I'm in the hot seat now.
So you guys use BTC and Bitcoin interchangeably, and it's something I hear all the time. Drives me nuts.
Yeah.
Because they are not the same thing. But are you guys leveraging BTC or are you leveraging Bitcoin? Because do I have to move it out of my cold wallet in order for you to loan it against it?
It's over collateralized, yeah, and so you have to send it to us. Yeah, yeah. But it's not wrapped or anything like that.
I understand, but it's okay.
Yeah, for sure.
That was my main question.
Cool, thanks.
And for those who are confused, the distinction is BTC is the asset, Bitcoin is the network. Do I have that right?
It's more like, okay, Bitcoin is the actual asset itself. When you have it in a cold wallet, you own the asset entirely. BTC is a leveraged product that is traded on the open market. It's a stock. BTC is a stock. Bitcoin is the asset. So BTC is leveraged on Bitcoin, and your loans are leveraged on BTC. That was my question. What's the loan to value on that?
We can go up to 60% loan to value. Yeah.
And you lend against the miners?
No, so just to, yeah.
Yeah.
So like machine financing is an interesting world, and it's not a readily available product right now. I think that'll change in time because there's a market for it. But I think that, you know, it's not potato by any means to just wave over that, but like it is a way to leverage your Bitcoin to, you know, acquire the asset. So it is financing, collateralized financing to buy ASICs or not buy ASICs. But it's not specifically against ASICs.
What are the terms, so for 60% LTV, and then it goes down, say the price of the Bitcoin that I pledged is going down, so I don't have that 60 anymore. What are the kind of, there usually like some kind of waterfall. Can you explain?
Yeah.
When you need more, it's either cash or more Bitcoin.
Yeah. So we would need more Bitcoin if you go above the 60% range. And so I think at 70%, there's margin call. 80% is actually a partial liquidation, right? But through that period, there's a lot of notifications and calls from our team chatting with you about where you currently are at and, you know, sort of how you want to deal with this. We describe it sort of as a line of credit functionality. And so at any point you can, if you're below 60, you're able to pull more collateral if you'd like. If the price goes up, same thing.
That's spelled out on your website then?
Yeah, super fully, and you'll receive a customized contract with all the details around that. And also you'll actually have a dashboard outlining for you the current LTV, the collateral that's available to you for like an upsize. All of that is free, and also the potential to, you know, pay back early. All of that is also included for free. Anchorage Digital is our custodian. And as I mentioned before, just for repetition, they are bankruptcy remote, insured, and we also have a backup servicer as well.
So what does that look like? Is it some kind of a multi-sig wallet that it goes into?
It's I think it's like a segregated address, and so you can actually get your own segregated address that you can monitor to make sure that the Bitcoin is never moving. Yeah.
That's nice. So it's effectively like proof of reserves for your collateral specifically.
Exactly, and I think that's something that a lot of times makes our clients feel more comfortable. They're used to being able to just look in their cold wallet, and so we want to make sure we mirror that while also sort of corresponding to the way we run our business.
Awesome. Well, if there's no more questions, make sure to give Nick a big round of applause because he flew in from New York and he's flying back tonight, same day.
Thanks so much. Really appreciate it.
And yeah, thank you everybody for coming out tonight. We really appreciate it. We'll be around to keep jamming, and thank you to the space for putting this all together. We've really enjoyed it.
Thank you guys. Appreciate it.